This set of slides is on human capital and asset allocation advice. So a person's financial situation and earning ability can often be captured by taking the person's human capital into consideration. Typically, younger investors have far more human capital than financial capital because they have many years to work and have had few years to save and accumulate financial wealth. Conversely, older investors tend to have more financial capital than human capital because they have fewer years ahead to work, but have accumulated financial capital. Human capital should be treated like any other asset class. It has its own risk and return properties and its own correlations with other financial asset classes. If asset allocation is indeed a critical determinant of investment and financial success, then given the large magnitude of human capital, one must include it. Investors should make sure to treat their total portfolios are properly diversified. In the early stages of the life cycle, financial capital should be used to hedge and diversify human capital rather than to naively build wealth. Think of financial investable assets as a defense and protection against adverse shocks to human capital, i.e. your salaries and wages, not an isolated pot of money to be blindly allocated for the long run. For example, many students of finance might expect to earn a lot during their lifetimes, but their relative incomes and bonuses will fluctuate from year to year in relation to the performance of the stock market, the industry they work in, and the unpredictable vagaries of the labour market. The human capital will almost entirely be invested in equity, so early in your working careers, their financial capital should be tilted slightly more towards bonds and other fixed income products. Of course, when they are young and can tolerate the ups and downs of the market, they should have some exposure to equities. But all else being equal, two individuals who are exactly 35 years old and have exactly the same projected annual income and retirement horizon should not have the same equity portfolio structure if their human capital differs in risk characteristics. Certainly, simplistic rules like 100 minus age should be invested in equities have no room in a sophisticated, holistic framework of wealth management. So it's prudent risk management to invest in industries and companies you know nothing or little about, or are unrelated to your work, as they have little correlation with your human capital. Think of the tech bubble. The key theoretical implications are that younger investors invest more in stocks than older investors. Investors with safe labour income invest more of their financial portfolio in stocks. Investors with labour income that is highly correlated with the stock markets invest their financial assets in less risky assets. And the ability to adjust labour supply increases an investor's allocation to stocks. Empirical studies show that investors do not sufficiently diversify in light of their human capital. Many invest heavily in the stock of the company for which they work. Only a small population of wealthy households hold a higher proportion of financial assets. So human capital can be calculated from the following equation. So human capital, HC, X is your current age, is equal to the sum of, for little n is life expectancy, through till time is current age plus 1. It's the sum of the expected, and in brackets HT, where H is earnings for year T, adjusted for inflation before retirement, divided by 1 plus R, R is the inflation adjusted risk-free rate, plus V, V is the discounted rate, adjusted to labour income risk, close brackets to the power of T, which is year T, minus X, which is your current age. And we assume that the investor has financial capital WT at the beginning of period T. The investor chooses the optimal allocation involving the risk-free asset and the risky asset that will maximize the expected utility of total wealth, which is the sum of financial capital and human capital, WT plus 1, which is wealth, plus human capital is HT plus 1. We assume the investor follows the constant relative risk aversion, CRRA, utility function, where utility is equal to wealth, total wealth, to the power of 1 minus y, where y is the coefficient of relative risk aversion and is greater than 0, divided by 1 minus y, where y is not equal to 1, and where y is equal to 1, then of course this becomes 1 minus 1, and 1 minus 1 is 1. Utility, or the utility function, is the natural logarithm of total wealth. I'm just going back to this one. The investor's human capital can be viewed as stock if both the correlation with a given financial market index and the volatility of labor income are high. It can be viewed as a bond if both the correlation and volatility are low. In between those two extremes, human capital is a diversified portfolio of stocks and bonds, plus some idiosyncratic risk. Alright, we're going to look at some case studies, and this is the base case. So we have a 25-year-old male investor whose annual income is expected to grow with inflation, and there is no uncertainty about his annual income of $50,000. So a job where there is no uncertainty might be a tenured professor. He's guaranteed his position as long as he wants to stay there. Or perhaps government jobs are sometimes viewed as very safe jobs with no risk. That, of course, in practicality may not be a realistic assumption, but they are less risky than, say, a contractor or someone that works in a mine where the commodity price or the demand for the commodity fluctuates wildly. Alright, so it's a fairly safe job. There's no uncertainty about his annual income. He saves 10% of income each year. He expects to receive $10,000 in pension payments each year when he retires at age 65. His current financial wealth is $50,000, of which 40% is invested in a risk-free asset and 60% is invested in a risky asset. He rebalances his financial portfolio annually back to the initial portfolio allocation. And we use the formula for human capital to estimate the value of human capital. So we have a table here of information for asset classes. So for bonds, which are regarded as the risk-free asset, the compounded annual return is 5% and it's risk-free, so there's no standard deviation. For risky asset classes like stocks, compounded annual return is 9% and there's 20% standard deviation risk. And inflation is 3%. Alright, so if we use the formulas, we can graph the trajectory of the value of human capital, financial capital, and total capital, or total wealth. And the graph shows that human capital is estimated to be about 800,000 at 25 years of age. It represents 94% of total wealth and far outweighs his financial capital at that age. His financial capital is only about 50,000. As the investor gets older and continues to make savings contributions, that money plus the return from the existing portfolio increase the proportion of financial capital. At age 65, human capital decreases to 128,000, which is to come from future Social Security payments or pension payments, and the financial portfolio peaks at just above 1.2 million. So case study number 1 is human capital as a risk-free asset. We have our 25-year-old male with an annual income of $50,000, and a current financial wealth of $50,000. There's no income uncertainty, so human capital is a risk-free asset because it is the present value of future income. The coefficient of relative risk aversion is assumed to be 5.5, so y is equal to 5.5. So when considering human capital, to keep the desired risk exposure of his total portfolio at the level indicated by y equals 5.5, the investor will choose a 100% stock asset allocation because he has already a 94% of his total wealth, represented by human capital, invested in bonds. Investing 100% in stocks is the closest we can get his total portfolio to the target desired risk exposure level without borrowing. When the investor is 45, his total wealth consists of about 40% financial assets and 60% human capital. The asset allocation is 60% stocks and 40% bonds. At 65, he ends up with a financial portfolio of 27% stocks and 73% bonds. This example illustrates that when an investor's human capital is riskless, the investor should invest more in stocks than an investor closer to retirement. And when an investor gets older, his human capital will decrease and financial capital will increase. Thus, the investor should gradually scale back the amount invested in stocks. Case study number 2 is human capital as a risky asset. So labour income, now we know, for this case we presume that labour income is risky. But the riskiness varies by the individual. There are two types of risk. Risk related to other risky assets, such as stocks, this is scenario 1, or risk uncorrelated with the stock market, which is scenario 2. And the dark bars are scenario 1 and the light bars are scenario 2. Apologies for the graph. So the riskiness of labour income varies by individuals, for example a stockbroker and a teacher. In scenario 1, a stockbroker or a stock portfolio manager would have human capital that is highly correlated with the risk of the stock market. An investor will use his financial assets to balance his human capital risk. If a stockbroker and a school teacher have the same total wealth and similar risk tolerances, human capital theory recommends that the stockbroker invest a smaller proportion of his financial assets in the stock market than the school teacher, because the stockbroker has implicitly invested his human capital in the stock market. In scenario 2, investors' labour income is independent of financial market risk. The investor's optimal financial asset allocation follows the same pattern as in the case in which the investor's human capital is risk-free, especially when the risk of human capital is small. The variance in the income over time is small. If the income uncertainty changes and becomes uncertain, you should refrain from taking too much risk with your financial capital. In case study 3, the impact of the initial financial wealth. So we have a 45-year-old investor. The risk preference is moderate, so it's a CRRA coefficient of 4. Y is 0.2, and the volatility of shocks to labour income is 5%. So this shows the impact of different amounts of current financial wealth on an optimal asset allocation. Assume that we hold the investor's age at 45, so this is all for his age at 45, and set the risk preference at a moderate level, a CRRA risk aversion coefficient of 4. The correlation between shocks to labour income and the risk asset returns is 0.2, and the volatility of shocks to labour income is 5%. So the optimal allocation to the risk-free asset increases with initial wealth. This may seem inconsistent with the CRRA utility function because it implies that the optimal asset allocation will not change with the amount of wealth, either financial and human, the investor has. A classic example of the impact of human capital on optimal asset allocation. An increase in financial wealth not only increases total wealth, but also reduces the percentage of total wealth represented by human capital. In this case, human capital is a less risky asset. When initial wealth is low, human capital dominates. In summary, for a typical investor whose human capital is less risky than the stock market, the optimal asset allocation is more conservative the more financial assets the investor has. And here we have case study 4, the correlation between wage growth rate and stock returns. So we have our 45-year-old investor. CRRA, coefficient of relative risk aversion, is 4. Financial capital is 500,000. The investor's income is highly correlated with financial markets. So the optimal allocation becomes more conservative with increasing correlation between income and the stock market returns. A higher correlation between human capital and the stock market results in less diversification and thus higher risk for the total portfolio. To reduce risk, an investor must invest more financial wealth in the risk-free asset. So the implications for advisors are this. Investors should invest in financial assets that diversify and balance out their human capital. Young investors should invest more in risky assets, with the portion allocated to risky investors reduced as they get older. An investor with human capital that has a high correlation with stock market risk should also reduce the allocation to risky assets and increase the allocation to assets that are less correlated with the stock market.